Hello, boys and girls. This is Due Diligence here, and welcome to DD's Masterclass. It's not really masterclass, it's more like, free online graduate program if you want to know what graduate students in the finance program is learning. And there's some couple of logistics. One of the reason that this video got uploaded so late is because number two and I were traveling this weekend. It was pretty fun. We went to some densely forested areas, and we had some really great fun off-roading and all that kind of stuff. We might also start an off-roading channel because we're actually pretty heavy explorers who love to explore the western frontier. But anyways, here's the video. And for those of you who are on Patreon, because when we first upload this video, it's gonna be unlisted. So then for those of you who are on Patreon, you guys probably gonna have early access to this. And then after we got the thumbnail made, then everything is gonna be on YouTube. The whole point of the series is everybody get free education. Hopefully what I learned in class I can regurgitate and probably teach it better to you guys. And also, your ad revenue is gonna pay for my textbook because the textbooks are too expensive. Anyways, so this class is called Financial Forecasting. And for class one, we were gonna talk about the class structure, what's the difference between, if you go to a graduate school versus our structure, and teaching style, if you go to graduate school and versus our structure. And we're gonna give you guys some homework, and we're gonna get you guys some class content, of course. Oh, shit. Class structure. If you go to a business school, on how this class is constructed, it's gonna be like cases from Harvard Business School packet, and then it costs about $90 to $100, and you solve business problems, quote unquote solving, because in reality there's no such thing as one business problem, and there's no a definitive answer to any business problems per se. You might be able to have like different conclusions and solutions for one problem, and maybe only one or two in real life that will work. But in those these packets, they have educators' notes or teachers' notes or professors' notes. They sort of give you a definitive answer. I mean, consider those are cases from the past. We can just use hindsight 2020 or 2021 to solve those cases. But in reality, if you were actually put in that spot, there are a lot of things that a lot of those sample solutions are missing, and a lot of things are just not included in the sample solutions, or in reality some of those sample solution might not even work. So yeah, so how we're gonna teach is this. We first gonna teach you guys some business basics, right? Because a lot of you are not business majors, have never been to business school, and who want to be investors, who want to invest in stock. And we gotta give you guys some basic financial information, or basic financial basics, so you guys can understand, in these financial statements, these are assets, liabilities, and owner's equity. What are those? Like, very simple, right? And why are they important? Blah, 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 right? And we're gonna introduce the case every single class if there's a new case, and we're gonna find some problems within that case. It's gonna be very open-ended, because we believe that a lot of you might spot problems that we haven't spotted, and we might even find problems that the simple solution haven't found, and we're gonna give some potential kick-ass solution to those problems that are way much more better than a school provided answer, or whatever, the graduate school, when the professor just stay on stage or at the podium just reading the words from the slides, or just giving you guys quote unquote the right answer. There's no such thing as the right answer. And all of those classes is gonna be less time consuming than graduate school, because every graduate school class is around 2 hours, and we're trying to condense all of those classes to less than 20 minutes. So good for you guys, right? Next slide. So the teaching style in school, the teaching style is most of the time the professor is just going over homework, because the homework is basically reviewing the class before and sort of like overviewing the class after. So for example, like for class one, the professor would just give you the case and tell you to do it yourself first, and then in class they're gonna go over the homework and teach you like what they think is right, or what the sample solution is giving them. And the homework, aka the case, is solved in an Excel file, and then there might be some potential classmate discussions, but most of the time the professor are too busy lecturing, so there's no discussions per se. So yeah, this is pretty much graduate school for you. And how we're gonna teach it is we're gonna teach business basics, and we're gonna sort of teach how significant, why these business basics are there. and then why is it important for average investor to understand how to read a financial statement, right? And we're gonna go over the case as how we see it. For example, like it's just gonna be a very fresh point of view in terms of how we see the case, the relevance, and we're gonna sort of tie it up with current event, and we're gonna go over the discussion in comments and on Discord if anyone participates. And homework. Homework in school, homework in graduate school is just going to be solving problems regarding the Harvard Business School packet, right? And they're going to give you a bunch of questions that either related or non-related, and some of them are pretty bad or pretty easily answered questions. How our version is, we're going to think about like what could go wrong as different roles in the financial world. For example, like in this case, right, we're going to talk about a lumber company. Then we want you guys to think as the business owner, as the bankers, but also as someone who is like a potential investor in this company. Like, what do you see in this company? What are some potentials? What are some problems you see in those companies in all these different roles, right? For example, for investors, maybe, a short-term, maybe long-term debt will be a super huge problem because due to liquidation preferences. But maybe for bankers, it doesn't matter if they have, previous debt or anything, because, this company might be a company that is, cash scarce and needs bank loans to expand or to, to vertically integrate or to vertically expand faster and faster, right? This is why a lot of banks would issue more leverage or issue more loans. We're going to talk about that later, right? In this class or the class later, or just throughout the entire course, okay? And how do an average investor benefit from the things we learn? For example, a lot of you are going to be asking, like, what's the whole point of solving this case, right? We're going to talk about this. Like, the reason why we want to solve this case is because of A, B, and C. And by learning these A, B, and C ratios, by learning A, B, and C principles, we will know that when we invest in, for example, MMAT stock, then you're going to look at this and this, and this is going to be a red flag. And because we learned about a company that does lumber, then maybe later on when we are investing in some foresting businesses, investing these seasonalities, we can apply what we learned from this cases to investment. It's like, oh my god, it's a seasonality, it's a seasonal business, right? So maybe in August it's going to go up, so we're probably going to load up some options on July, buy some monthly options, and we start loading up some early August, and we'll wait for the seasonality to end, the earnings and sales goes up, and bam, stock shows up, right? And discussing in comments and Discord, if you choose to participate, you're more than welcome to ask us questions on the comment section and in Discord, and maybe do those homeworks and sort of like post your solutions or post what you see as problems, or basically answer those questions in these comments in the Discord, and we're going to talk about them. And if we see some very eye-catching answers, we're probably going to talk about it in the next class. So this class is called Financial Essentials, right? Financial Forecasting Essentials. So why do we do financial forecasts, right? You see all these, fancy Goldman Sachs boys or these fancy Morgan Stanley boys, they do a lot of forecasts. Like, why would they do that? It's because a lot of times when you're pitching to investors, you need to tell them, okay, so year one we made $1 million in revenue, year two we make $2 million, year three we made $3 million, and all of a sudden our forecast for year four is actually more than $6 million. And then when you say that forecast, the investors are like, oh my god, why from year 3 to year 4 there's a 100% increase? And it sort of catch their eyes, and they're gonna ask you more questions, and maybe you will get their money, or maybe you won't, right? And also, forecasting is a very good way to sort of inform your potential investors or your future investors or your existing investors that, hey, like, our forecast is like this. And year 1 to year 2, year 2 to year 3, year 3 to year 4 is all gonna be a 20% flat increase. This sort of like sets up a pretense for investors and be like, oh, this is this kind of business, and by giving you guys these forecasts, we're telling you guys, okay, this is normal operational, margin. This is normal operational range in terms of revenue. And if we fall under this line, maybe there's something wrong with our business, or maybe there's something that you really want to know about our business, or maybe hey, maybe because the reason why our revenue goes down by under our forecast is because we wanna really invest in R&D, or maybe we wanna really expand our business in a very short period of time. Why? Because we foresee some competitors, right? So forecasting is everything. And then when you're in a business that does inventory forecasting, for example, if you're selling apparels, right, inventory management is one of the most important thing in your business, because the more inventory you have on hand that are not sold off, that means you need to pay for the warehouse. You pay for more space to host these inventories, which is bad. The best business model is when you're a sort of like a inventory center business, Apple or apparel. You don't want to have any inventories because you don't want to buy any warehouse, which will maximize your shareholder value, or which will maximize your net income. This is what we all want to see, right? Investor want to see a higher net income. Business owner want to see a higher net income. Your employees want to see a higher net income. So how would you do forecast, right? There are a lot of ways to do it. For example, a lot of people use very simple forecasting method. It's like, okay, from year 2 to year 3, from year 3 to year 4, you only have a 20% increase, or on average, you have a 20% increase on revenue. So on year 5 or year 6, we decide to apply the same amount of growth, right? Or you can do a linear regression like how I do it. In this course, I will teach you most of the things, like how would you do a simple forecast, how would you do a linear regression, and how would you do the DD ways or forecast. I will give the DD ways is a little bit more complex, so it's gonna be like later on in the course, like maybe class 10 or maybe class 20. I'm probably not gonna do a 10 class, probably I think this class is like 15 class tops. I think like 11 class tops. So on the last day of class or the last class, I want to talk about how exactly do I do my forecast. My forecast is more mathematical and have more math oriented in them, and sometimes they have black box equations, sometimes have some machine learning shit. That's why a lot of our forecasting, a lot of the price predictions are correct. You probably will have like a sneaky peek of like the insider mind of how beautiful DD's mind is. Okay, so what exactly forecast we already explained, right? It's basically a forward-looking statement or forward-looking into the future. It's not really, forecasts are not actual numbers, right? They're like what we think is gonna happen, or more like what we hope is gonna happen. And sometimes forecasts can be lower, and sometimes forecasts can be higher, right? As a stock investor, you want this forecast to be a little bit lower, so then your actual is gonna be higher. So then your revenue is gonna have a beat, and people is gonna FOMO the stock, and you will see a short-term high. So things to know before analysis, right? So for those of you who don't have an accounting background or don't have a business background, you have to know the basics about the balance sheet. So every company has to provide a balance sheet every quarter, or every month, depending on what regulatory basket you're in. And the general equation you have to understand is asset equals liability plus owner's equity. And if you switch up the math a little bit, it's going to be asset minus liability equals to equity. So what is asset? Asset is what you will have or what you already have. For example, your property that you already on your books. The houses you already buy, right? The rent you already paid, prepaid rent. Or cash is one of the most important assets. Long-term investment is an asset. What is a liability? Liabilities is what you owe, right? For example, account payable is a liability. The accounts that you already received the goods from your supplier, but you haven't paid them yet, right? Note payable, right? Note payable is just a more finesse way of saying you own people money. Note payable is the bank loans, right? Long-term note payable and all those kinds of liabilities, right? Payroll liabilities, you gotta pay your labor, you gotta pay your employees every single month, and they've already rendered their service. So then, at the month end, maybe you need to pay for their, payroll. So then payroll is still a liability right now, right? Equity is what you earn or what you spend. For example, expenses are equity, right? And also like, R&D expenses are a part of the equity thing. And you will have stuff like, retained earnings is basically all the previous revenue that are piled up that you reinvested or still haven't been distributed to your shareholders or get into the retained earning basket, or revenue is part of your equity, right? So what does balance sheet look like? This is what balance sheets look like. You have, the year, you have, um, this is one of the asset titles, or the asset ladder. You have cash, account receivable, inventory, properties, and you have total asset. And then liability side, you have note payable, account payable, accrued expenses. This is a bit tricky, okay? This is a little bit tricky. We will talk about this in our accounting class. We call it the accounting master class. We're going to talk about accrued expenses and why is it different from other expenses that are in the equity section. And you will have, long-term debt, that's part of the liability, and short-term debt, right? The current portion of long-term debt is short-term debt, or just current portion of the long-term debt you have to pay off this quarter. And then net worth is just another way of saying owner's equity. And then you have total liabilities and net worth. Income statement, right? Income statement is what you earn or spend this quarter ended in, say, I don't know, January 21st, 2021, or January 30th, 2021, December 30th, December 31st, 2021, depending on your reporting cutoff line is. And usually the income statement equation is you have your net sales, so this is your revenue, right, minus cost of goods sold. What is cost of goods sold? They're basically the cost for your revenue. For example, George is shorting George. For those of you who don't know what MMAT is, it's basically a stock that is a portion of our viewer base that invest in. It's called Metamaterial, and its CEO is George, right? And then their principal item right now, or product, is goggles. So in order to sell those goggles, they have to produce those goggles. So then these goggles have a cost. Let's just say these people, MMT sells these goggles for $900, and its cost of goods sold is $600. What does it mean is we sell those goggles for $900. It takes $600 to make. Then what's our gross profit? It's gonna be $300, right? 900 minus 300 equal 900 minus 600 equals 300. But $300 is not what you're gonna have in hand, right, when you sell those goggles, because you still have to consider there are other expenses included. For example, general admin expenses. You gotta pay your executives like George, right? You gotta pay for overhead expenses, and then after you pay all these expenses, you have net income before tax. Yeah, you do have this evil thing called taxes, and everybody has to pay for them. And after you pay for tax, you'll have net income. So what does a income statement look like? Income statement looks like this, right? You have net sales, cost of goods sold. Again, in our master accounting class, we're gonna go more in depth about these balance sheet, income statement, gross profit, operating expenses, net income before tax, income taxes, and net income. Ratios. Ratios are important, but also they're not important. Why? Because we're probably just gonna make a separate 8-minute video or shorter video about ratios, because you can literally just search up all these ratios online, and you don't need to go to a master's class to talk about ratios. But ironically, in a master's class or a graduate school, people talk about ratio all the time. But the thing is, I think this is where I think a lot of financial analysts fail, because they use a fixed ratio. Sometimes you have to determine your own ratio. I mean, ratio, we gotta give them credits, right? There are a lot of things that, for example, if you look at inventory, and you can look at inventory, like the inventory cycle. For example, how long does it take for this company to clear out, its inventory per month, or by its balance sheet? How do you do that? Then we can probably gonna do, inventory days. Like there's a ratio that calculate that. That's very useful. But most of the times, a lot of master courses tell you to calculate quick ratio, current ratio, and all this kind of stuff. In reality, if you are a stock investor, or if you're investing in general, a lot of those things are not useful at all. Different industry have to go by different multiplier. Different industry have to go by different sort of standards. For example, in a lumber business, maybe it is acceptable for you to have higher leverage, acceptable for you to have higher debt, because if you're just purely selling lumber, you're not really offering the consumer a lot of value. Therefore, your margins is really thin, right? But if you are a tech company, maybe having a lot of debt is not what you want to have, because if you use the Apple model or any SaaS model, you literally have zero inventory. So it's unacceptable for you to sort of have a higher debt, because your revenue and your core revenue minus expenses is supposed to support your business year by year, quarter by quarter, and the consumers and the investors are looking forward to a higher growth. Thus, they want you to see your net income increasing. But when you have a lot of debt due to interest expense, your net income will probably decrease over time. So this is like a case by case scenario. So don't just like go by, oh, in this case we talk about this ratio, next case we have to use this ratio. No, you have to pick the ratio that fits the best for this industry, or fits best for this case, or fits with this problem, right? That's why I always talk about like the master class or graduate school spend too much time talking about ratios without really telling you why they're significant and their downfalls. And in this class, we're going to talk about it. And there are too many different versions of the names of ratio. For example, leverage. You can calculate leverage like 6 different ways, and in stocks leverage means A. In case analysis, leverage means B. In general balance sheet analysis, leverage means C. So it's very confusing. If you're not in finance, you don't know what they're talking about. Yes, don't get me started. There's too much shit that I don't really want to cover about ratios. A lot of people just get them wrong. I mean, a general rule of thumb is, most of them are quite useful in a regular sort of like a situation if you just want to be a mediocre analyst. But if you really want to be good at your job, if you really want to know what really is going on with this company, you have to sort of have a deep understanding of why we're using these ratios, why a ratio is important in situation A, but in situation B, the other one will give you the better results. So let's talk about the cases. We'll give you a general rundown of the cases, right? So basically, we are talking about this lumber business. Let's just call this lumber business Bartley Lumbers or whatever, right? Company A. So this company is operating in late 1990s. And then what this company do is it do direct lumber sales to customers. What it means is, say, DD started this company, and DD decided to source some lumber from a random supplier overseas. And when we got these lumber, we give it a markup and we sell it back to customers or businesses, right? There's no other value added. Like, we don't do carpentry, we don't do anything that, okay, for example, we don't, pre-cut your lumber for you. We don't do anything to differentiate us from other lumber business. So basically, we're just a wholesaler or a distributor, a lumber distributor. So it's bound to be we're bound to have a lot of competitors, because it's not really a high barrier to enter sort of business. There's no patent, there's no protection or anything. Like, anyone who can go on Alibaba or go on anything to send an email to some random lumber supplier overseas, and they will be able to have as long as they pay the cash for the lumber, right? They will have the goods to sell to consumers. And another thing you need to know about this is the owner is a pretty energetic guy and is very hardworking, because we're going to analyze it in a sort of like if you were a banker, whether you're going to give this this business a loan or not perspective. So the people element is also very important. I mean, another thing I want to flame about the master course is it focused too much on the numbers or technical analysis, but at the same time, these technical analysis are based on like textbooks that are written 20 or 10 years ago. But in reality, if you work in investment banking or in VC, people is the most important thing. You don't really invest in the numbers, because a lot of times in these early stage investments, numbers doesn't really matter as much. I'm not saying it doesn't matter at all. Fundamentals still matters, but most importantly, you invest in the team, in the people in that team, okay? The business model for this company is, I've already covered it, right? We buy lumber from suppliers and we sell lumber to consumers. It's that simple. There's no other value added. It's not because like we buy lumber from suppliers, we don't do any further manufacturing, or we don't do any, we don't make lumber into chairs. If we make lumber into chairs, you probably can make more money, right? But you also need to solve other problems, like how do you source your customers, right? This is very straightforward, okay? And what do you, just from these facts, right? What does all these facts tell you about this company? Like, do you think this company is very profitable? How do you think about like this company? Does it have a lot of competitors? Like, how do you weed out competitors when you are the owner of the company, right? And then what are some facts that you think is important, right? What are some facts that you think is important that we are not covered here, right? This is one of the things that you think about when teaching this class. Should I just post out like these cases online as PDFs, or or post it like as a link on a Google Doc? Because technically, um, or I can like paraphrase it like this to you guys, because technically you're supposed to buy your own course material, but it's too expensive. So you know what? Me and number two is gonna think about a way to sort of bypass or just think about a loophole to that. Maybe you can download some course materials, in our Discord or something like that, right? And also, like, what's your grip on lumber business? Like, do you guys have prior experience with the lumber business? Do you know if you invest $1 million in lumber business, how much million you're expecting in 1, 2, or 3 years? Like, what's your expectation for lumber business, right? It's not like Google or Tesla or something like that. You'll probably expect a higher return on this. What is a reasonable return that you think would it be for a lumber business per year? Like a reasonable return on investment, or a reasonable, a growth on revenue, or a reasonable decreasing of, cost of goods sold, or increasing of operating margin, right? I think this is it for this class. We're gonna do some homework. I think we covered a lot of things. I mean, as a master's student, you should think on your own and maybe do some research on your own. And in the next class, we're gonna talk about it, and we're gonna dump some more information to you guys. So as you can see, higher education is more about studying yourself than actually learning from lectures per se. But in here, because a lot of you probably are here just like listening to this podcast, so then I'm gonna just dump a bunch of information to you every single class, and you guys can think about stuff later. Or if you guys have any suggestion on how we should teach this class, just comment down below. We can accommodate to a lot of you guys. For example, you guys think, oh my god, this is too high level, or we want some more detailed stuff, or like, would you just go over some really really basic stuff, like for example, going more in depth in assets, or going more in depth in liabilities or owner's equity, or make the case a little bit more detailed? We can all do that. And then as long as we can help you guys learn, we're here for you guys. Okay. So first homework is do some analysis on the financial statements that we already posted in those slides. You can go back and download or take a screenshot of that particular slide, or maybe we're probably gonna post the PowerPoint in Discord. And second homework is how would you forecast the finances in the next few years? We're gonna talk about basis and biases and the basis of how to forecast next class, but this class, as homework, you guys should just try it out for yourself, right? You copy and paste, or you take a screenshot of all these numbers in this financial statement, and maybe just trying to forecast it for yourself. There's not really a direct right way of forecasting. We can only teach you guys what are some industry standard, or some easy way to do it, or some DD ways to do it, right? And also, if you're a banker, would you give this company a loan for 465K next year? Would you? Right? If you go back and look at the balance sheet here, you see the previous no payable bank. This is bank loan. The previous bank loan is here, right? Like year two, they got a bank loan of 146,000. Year three is 233. Year four is just the first quarter. They've already anticipated to have to get at least 247. So as a banker, would you agree to give them twice the amount of money that they were getting from previous years, right? If you look at this, like twice the amount of money, right? Like, why would you give it to them, or why wouldn't you give it to them, right? Why not? Think about those, right? And then the last question is, without doing any forecasting, what do you think the problems are? Or are there any problems? Like, by just looking at all these statements, right? Like, if you look at all these statements, can you find a problem here? Like, what do you think is going to be potentially a time bomb, or just no problem at all? This business is really healthy. Like, think about those, right? And tell us about why and why not, or just think about it. Now, of course, next class we're gonna go over that. But the whole point of being an intellectual human being, or being an independent investor, is you have to form your own critical thinking process, and form your own decision, or form your own opinion on what is wrong with this company? How would I fix it? Or, if there's nothing wrong with the business, what are some future problems that we foresee in year 4 or year 5, right? We will unpack this a little bit next class. I think this is it for this class. I'm going to go check how long does it take for us to cover this. I think 20 minutes. But see you guys on the upside. Hopefully you guys will ask some questions. And we're going to be posting more videos on interest rate, on other things tomorrow, because today we just finished traveling. See you guys on the upside.